Now there's 7 key points and we're only going to focus on the need to knows. Key point number 1, insurance is the transfer of risk. Insured's loss are transferred over to the insurer. The memory trick we use here is insurance. Think you are in good hands and 100% sure of protection. Key point number 2, only pure risks are insurable. The memory trick we use here, pure risk. Think pure loss. Only loss here, no upside. The threat that is beyond a human control, resulting only in a loss or damage. Now, this is an incident such as a natural disaster, fire, or an untimely death. Think not gambling. Let's consider Tricky Ricky. He's a gambler, loves to go to Vegas, favorite game, blackjack. Obviously, gambling is a gamble, a win or a loss, no guarantee. The risk with each hand is speculative. Key point number 3, a risk is a chance that a loss will occur. Peril is the cause of a loss. Hazard increases the probability of loss. And a morale hazard is the attitude behind the loss. The memory trick we use here is risk. Think risky business. Higher chance that loss will occur. Peril, think problem. It's the problem that causes the loss. For example, the actual car accident is the peril. It's the problem causing the loss. Hazard, I want you to think hazy horizon. Can't see clearly. Increased risk of loss. Morale hazard, think moron hazard. You're being an idiot with a hazy horizon and therefore a higher risk for loss. The example here is eating while driving, or even putting on makeup while driving would be considered a morale hazard. Key point number 4, insurable interest must exist at the time of application. The memory trick we use here is insurable interest in time of application, or say application time is the appropriate time for insurable interest. Key point number 5, the policy owner must have insurable interest in the life of the insured. The memory trick we use here is policy owner, think priority over the insured. They have an interest in the life of the person they are insuring. Key point number 6, methods of managing risk. Here's the memory trick we use. Think rats. R for retention, R for reduction, A for avoidance, T transfer, S sharing. Rats. Key point number 7, indemnity indicates the insured cannot recover more than their loss. Memory trick here, guys, think indemnity means you won't be in debt to me. You only get out what you put in. For example, you cannot insure a 1990 Honda Civic and total it and expect to get a new Ferrari. Doesn't work that way. Again, indemnity means that the insurance company only restores to the same financial position as prior to the loss. Honda Civic, not a Ferrari. This module will give you an introduction to some of the most basic terms and concepts in the insurance industry. Here are some learning outcomes you will find in this module. Be able to identify the definition of insurance. Explain the law of large numbers and why it's used. Know what insurable interest is and when it must exist in life insurance policies. Identify risk management techniques. Now, connecting back to some of our key points, remember, insurance is the transfer of risk. Insured's losses are transferred over to the insurer. Speculative risk involves the opportunity for either a loss or a gain. A good example is gambling. And remember, this type of risk is uninsurable. When thinking about peril and hazards, keep this in mind. Morale hazard is your attitude towards safety. Peril is what happens because of that attitude, the accident itself. The basis of insurance is sharing risk among a large pool of people with similar exposure to loss. The law of large numbers states that the larger the amount of people with similar exposure to loss, the more predictable the actual losses will be. Now, connecting back to our key points, a risk is a chance that a loss will occur. A hazard increases the probability of loss. A peril is the cause of the actual loss. Adverse selection for insurers occurs when an applicant manages to obtain coverage at a lower premium than the insurance company would charge if they were aware of the actual risks regarding the applicant. This usually happens as a result of an applicant withholding relevant information or providing false information. Now, connecting back to some of our key points from the beginning, insurable interest must exist at the time of the application. Also, keep in mind, key point, the policy owner must have insurable interest in the life of the insured. Indemnity is a guarantee to restore the insured to the position he or she was in before the uncertain incident that caused the loss for the insured. The insurer, the provider, compensates the insured, the policyholder. What type of risk is insurable? Only pure risk that results in pure loss. What are the methods of managing risk? Remember, RATs. R stands for retention, R stands for reduction, A stands for avoidance, T stands for transfer, and S stands for sharing. When must insurable interest exist in life insurance? At the time of the application. Now let's take a second and review our learning outcomes. You should be able to identify the definition of insurance. You should know how to explain the law of large numbers and why it's used. Know what insurable interest is and when it must exist, and also identify risk management techniques.